Real estate and stocks are two of the most common paths people consider when trying to build wealth. Both have created enormous fortunes. Both have also disappointed investors who entered with unrealistic expectations. The real question is not which one is universally better, but which one is more likely to make you more money under the conditions you actually face. Many people approach this decision emotionally. Real estate feels tangible. You can see the property, touch the walls, and collect rent from something physical. Stocks feel abstract, numbers moving on a screen, ownership of businesses most people never visit. Because of that, property often feels safer, even when the math may be more complicated. Let's begin with stocks. When you buy a diversified stock index fund, you are purchasing small ownership pieces of many businesses. Those companies grow earnings, reinvest profits, and often pay dividends. Historically, broad stock markets have delivered strong long-term returns, though never in a straight line. Some years are excellent, some years are painful, but over decades the compounding effect can be powerful. Stocks also offer efficiency. You can start with small amounts, invest monthly, reinvest dividends automatically, and remain diversified with very little effort. There are no tenants, no leaking roofs, no property taxes to negotiate, and no midnight repair calls. For many people, the simplicity of consistent stock investing is one of its biggest advantages. Now consider real estate. Property can generate returns in several ways at once. First, the property value may rise over time. Second, rent may create monthly cash flow. Third, tenants may help pay down the mortgage balance. Fourth, leverage allows you to control a large asset with a smaller down payment. This leverage is where real estate can look extremely attractive. Imagine a $300,000 property bought with a 20% down payment, or $60,000. If the property rises 5% in value, that is a $15,000 gain on a $60,000 initial equity investment before costs. On paper, that looks like a 25% gain on your cash invested. This is why many people become enthusiastic about property. But leverage works both ways. If the property falls 5%, that same $15,000 decline hits your equity. Costs also matter. Mortgage interest, insurance, taxes, maintenance, vacancy periods, repairs, transaction fees, and time spent managing the asset can quietly reduce returns. Real estate math often looks strongest before expenses are fully counted. Stocks have costs too, mainly market volatility and emotional difficulty. Many investors buy high, panic during downturns, and sell low. The greatest risk in stocks is often not the market itself, but investor behavior. Real estate can feel calmer because prices are not displayed every second, but that does not mean risk is absent. It simply feels quieter. So which one makes more money? If you compare a disciplined stock investor, who contributes monthly for decades against an average property investor with heavy costs and poor management, stocks may win. If you compare a skilled real estate investor using smart leverage, buying well, managing efficiently, and holding long-term, real estate may outperform. Outcomes depend heavily on execution. Liquidity is another major difference. Stocks can usually be sold quickly in small amounts, need $5,000. You can often sell part of a portfolio. Real estate is slower. Selling a property may take weeks or months, involve fees, and require all-or-nothing decisions. That flexibility has real value. Diversification matters too. One rental property may represent a single neighborhood, a single tenant, and a single asset. A stock index fund can represent hundreds or thousands of companies across industries. Concentration can create upside, but it also increases specific risk. There is also the lifestyle factor. Some people enjoy analyzing deals, improving properties, and managing rentals. Others want passive wealth building with minimal attention. The best investment is often the one you can sustain consistently without burning out or making emotional mistakes. The real math usually comes down to 5 variables: return, leverage, costs, time, and behavior. Real estate often wins on leverage and forced equity building. Stocks often win on simplicity, diversification, and low friction. Neither asset class automatically makes you rich. Both reward patience and punish unrealistic expectations. For many investors, the smartest answer is not choosing one side forever. It may be using stocks for liquid, Passive compounding while using real estate selectively when opportunities are strong and the numbers truly work. Wealth is often built not by loyalty to one asset, but by understanding the strengths and weaknesses of each. In the end, the question is not real estate or stocks. The better question is, which one fits my capital, skills, risk tolerance, and behavior? Because the asset that makes the most money on paper is useless if it is the wrong fit in real life.